What does the financial section of the business plan look like? Nothing works without money, which is why financial planning is at the core of every business plan. The financial section of the business plan should address the following points. How much money will you need in the startup phase, and from what sources do you plan to get it? To clarify this point, you need a capital requirements plan, which covers all long, medium and short-term investments, running costs during the startup phase and all initial setup costs. You also need to outline the revenue and costs you can expect over the next 3 years. This calculation shows how much profit you can expect to realize in this period. A 3-year revenue and profitability forecast summarizes this information. The figures must stand up to plausibility checks. Sound financial planning also includes a liquidity plan. A company is liquid or solvent if it has sufficient revenue, reserves, and/or credit facilities to cover its costs at all times. Here is a useful hint. For young companies, the 3rd year is often critical. That is why this period is covered in the financial section of the business plan. Many young companies make a profit for the first time in their 2nd year, which means that trade and income tax must be paid retroactively in the 3rd year, at the same time as advanced tax payments for the future. This is also often the year in which repayment of startup loans must begin. All these factors place heavy demands on your liquidity. It is therefore important to plan ahead if you want to achieve lasting success. A robust business plan is also a precondition for credit negotiations with banks. Okay? Got that?